Welcome back to the Investor Professor podcast. This is Dr. Ryan Peckham, and this is episode 161. On today's episode, we're going to talk about the uncertainty that we have going on in the market today. So that'll be political uncertainty, tariff uncertainty, market uncertainty, all of the above. I got Cameron joining me today, so get your mind right and let's get to work. Well, welcome back to the podcast, everybody. Cameron, happy Sunday to you.
Yeah, a little later in the week we're recording.
Late in the week, early in the week. Yeah, late in the week. So we're doing this on Sunday afternoon. The futures just opened for tomorrow, and I thought it would give us recording later. We just had a bunch of stuff to do on Friday, so thought this would give us a little bit more time. But I'm not so sure, man. There's a lot of uncertainty going on in the market right now.
As we're already seeing, not even 30 minutes into it.
Yeah, I wonder, there was an article
Futures.
about like people being able to trade 24 hours a day. Just not so sure how that's going to go.
I hope that doesn't happen.
No, I think the NASDAQ approved it. That they want to get there eventually.
Yeah, that's crazy.
So why do you say you hope it doesn't happen?
Well, selfishly, it makes our job a little more difficult, I think, because information flow. But also, too, I think it creates people like my generation, a lot of sports betting, all that crazy stuff, odd hours a night. So it just gives them another avenue, I think, to bet, 24 hours.
Yeah. Yeah, so I looked up an interesting statistic. So how old do you think most baby boomers were when they opened their first investment account?
Oh, it's probably pretty. I was going to say it's probably pretty late.
It's like 35
Yeah.
on average.
Okay.
So Gen Z, how old do you think they are when they get their first investment account?
Or is this like 401k or is this like
No, just like
everything,
brokerage account, whatever.
I'd probably say like early 20s.
19.
Yeah, there you go. Well, how does it make you feel?
No,
Oh,
I mean
man.
it's just, but it's showing you you're talking about two totally different generations, and you think about like the habits that are being created, and like you said that if there's a 24-hour market, it really hurts information flow. But don't you think that there's people having, investors having trouble digesting information flow now?
100%. That's why there's volatility.
Yeah, and I don't think that so there was a really cool chart I saw this week that I wanted to show you, but it showed that there have been more days of a 2% plus move in the market from 2000 to 2004 than all the other years combined from 2000 previous.
Why is that?
There wasn't any online trading.
Oh.
And you had to pay a huge commission to sell out of your stock.
Yeah.
So if back in 1996, you had to call somebody if you wanted to trade out of $10,000 worth of stock or whatever, it would have cost you about $700 or whatever the commission would have been. Now there's no frictional commission costs. And so, the brokers trying to make up that money, I mean, they need you to trade more often. They need you to trade more often. And now 50% of all trading is computers.
Do you think it would smooth out the volatility? Okay, so if you move to 24 hours, it's not 7 days a week. It's like 6, right? Or something like that.
Yeah, I mean, okay.
So if we move to a 24-hour trading period, or I think it's 23, but if we move to that, do you think it's going to smooth out the volatility, or do you think it's going to amplify it?
No, I think it'll make. I mean, I think there'll be times
Average
where,
over time.
Yeah, I mean, maybe I don't know. After a while, people will exhaust themselves. I don't know. I don't know what moves people are making at 2 a.m. that they're going to feel good about. I still
That's
think
a
it's
good point too.
I mean, I still
agree.
think it's the I'm doing some form of activity that makes me feel good. The brokerage houses are going to want you to trade because that's I mean they're making a little bit of money. They need the increase in volume.
Your Instagram feed is probably going to be full of more of the day trade your life to be a millionaire.
Yeah.
Buy my course.
Yeah, buy my system.
Buy my course.
For $29. Yeah.
But I don't know. On first glance, I think volatility would probably increase. But I also think, imagine there's probably recency bias at to this, what I'm about to say, because we just had a crazy market, but a lot of trading going into the close, especially on a Friday.
Right.
If there's no close, you take away that volatility.
Well, but there will have to be close. I mean, like, we're kind of getting into the weeds here, but there will have to be times where like options expire, those hard dates where you have like options expiration Fridays and things like that. But I mean, I'm not really sure how many professionals are going to be, trading at, crazy hours. I mean, I'm sure like it'd be interesting to see the breakdown between retail versus institution.
Yeah. I think they're going to, from what I've read, the proposition is we're going to make it more accessible to retail traders by opening it to hours that they're not actually working their career job.
Yeah.
Right.
Right.
But I don't think that's going to help them. I think it's going to hurt them.
Well, can you imagine working all day and then you come home and you start like day trading? I mean, 100%. You have to think like you only have so much cognitive power in a day.
I don't think
so. If you've been working all day and now you come home and you start like reading candlestick patterns, I'm not really sure how good it's going to be.
Yeah,
I'm not really sure how
bounces.
I'm not really sure how good that's going to go. But I mean, I bring that up because in times like today, when you have this kind of uncertainty in the market, I mean, you see how quickly things change and how quickly we go from greed to fear. And just how different the conversations are than they were 2 months ago. So, 2023, 2024, good years in the market, and might as well have been an eternity ago.
So to tie that into a question we got from a listener, you just talked about greed and fear moving the price of the market. So the question I think we got was, what moves the price of a stock, right?
Up or down, yeah.
Yeah. How much of that movement do you think is determined by greed and fear?
I mean, a lot. I think there's probably...
So let's just actually make that easier.
Yeah.
How much of the movement in the price of a stock is based off of emotion?
I'm for a segment of the market, I think a big percentage is. I think there's always a percentage of the market that is trading off of that momentum one way or the other. If you think about like the ocean, the choppy waters on top, right? So I think about like a value investor, somebody who does a dividend-based strategy. They're kind of down in the ocean. They're not noticing all the ripples up top. But somebody who's hasn't been in the position very long, trading the trading kind of the news. They're going to feel a lot of the gyrations on top. But I mean, what ends up happening is it's just, do you have more sellers or do you have more buyers? If you have more sellers, they're going to push the market down. The bid-ask spread goes, you have that dropping versus the other way. Also, too, when you have the market at a high, you always have more money that's margined. Like you have people that have borrowed money. Oh, yeah. There's a lot of money that's been borrowed to push the market up to new highs. And so I think what you've seen over the last 6 weeks or so, or at least the last month, is that like that money getting unwound. This is definitely not like a market you would want to be long with margin.
No.
So you don't know really how much is margin calls, that kind of thing.
That's funny though, because I'm sure there is probably some study. The use of margin, obviously from the basis of like, okay, you can get more margin because you have more collateral in an inflated market.
Right.
But there's also probably the behavior piece of that too, where people are getting more, they're probably utilizing more margin at highs in the market because they're going off of the whole momentum thing. And it's like, what do they call it, like the hot hand fallacy? I think they call it in poker. It's like when you get so many good cards, it's like, it's going to keep going. It's going to keep going. Yeah. But it doesn't.
Yeah. And in the market, that would be like projection bias, or you just have like the herd effect, or you're just following other people into trades. And so, it's easy for those, like when you have this kind of, probably the speed at which we've kind of come down here. I mean, like it just starts to unwind. And some of the points I wanted to make is like, when you look at, like, it seems like there's been a disproportionate reaction with the Magnificent Seven, but it's also because there's a disproportionate amount of them in all the ETFs and mutual funds. So if people are just selling everything, well, you're selling more of those because they were a larger piece of those indexes, right? So one of the things I showed you before was that it doesn't matter if it's the S&P 500, the Russell 3000, the Russell 1000 growth index, or the NASDAQ. I mean, the top 7 stocks are the Mag 7.
Isn't that crazy?
Well, yeah, it is crazy. I mean, so my point for like the listeners is we always all the financial advisors talk about being diversified, but if you own like a bunch of mutual funds or ETFs, like you have to go look at the top holdings in those and see like how much of the Mag 7 do you actually own.
Yeah.
Versus like it's fine. I mean, if you own individual stocks or whatever, but at least like, hey, only 6% of my portfolio is in this or whatever.
Yeah, I think it's like I don't know what you would call it, but it's definitely like a creep in the portfolio. So like your portfolio starts creeping in the direction of less diversification.
Correct.
But you have the assumption, maybe because you work with an advisor that sells mutual funds, but you have an assumption. It's like, oh, I'm in 18 different positions.
Right.
But there's really nothing in, like there's no, I don't know of any of the advisory shops that have software that will show exactly what is their allocation across
1%,
those mutual funds.
It's also if you own like funds, I mean, like to no fault of anybody in particular, it's hard not to be overexposed to those. Now these numbers that I just read, I mean this is a little bit dated. I think this is like December 31st, 2023. So I'm pretty sure Tesla has come down on this quite a bit.
Tesla's having a rough go.
So but when you look at this, I mean, it's so again, it's kind of going back to the 2022 playbook and not saying we're going to have a year like that, but I mean, 2022 playbook where you got to know what you own, how much you're exposed. So that is like what percentage of your portfolio is invested in whatever securities that you have. And starting to look at things that you're like, okay, like I want to own these stocks. Like you have to be very aware of what you own and do you still want to own them? And things that pay dividends so that you can be basically paid to wait for the news to get better. And also because the stocks that pay dividends, that'll act as kind of a parachute, if you will, as things go down.
Float. Yeah, it's kind of floating the portfolio a little bit.
And it's hard too. So I think some of this, like we're talking on Sunday night, so the futures have come out. We don't know how tomorrow is going to end up. But I think some of this is probably Trump's interview with the, Fox News this morning where he said like, he said he's not looking at the stock market. I don't believe him, but he says he's not looking at the stock market. He says there's going to be some pain. And so I think, there's investors that take that as like, I'm just going to sell out. But we talked, it's interesting, like Bitcoin's getting beat up, even though they just announced that they're going to do a crypto reserve. And so it seems like people are just like, investors are just kind of exhausted a little bit.
I'm sure. No, I can imagine that. It's funny. I think Trump is one of the most vocal presidents. Like, I think people have said that across the board, but at least in my lifetime, for sure.
Yeah, for sure. And especially if you're young, because do you even remember his first term?
I do a little bit, but I wasn't in the market like I am now.
Yeah, because that would have been 2016 to 2020. So you would have been like high school to college, basically.
Yeah, I remember.
Or that was your college years.
That was my college years because I think I was in your class when that was happening.
Correct.
And the stock competition, I just bought all the triple leveraged indexes because
that was a good move.
Yeah, he, very vocal, which is good in some sense, but it definitely makes the investor's job more difficult, especially like, and I watched the interview, all the headlines are saying, and you pointed this out, where it's like he was asked point blank about a recession and he said something about a transition period. It was kind of like, I think it was blowing it out of proportion a little bit. It wasn't as negative as I think some of the articles were saying it to be, but he did stutter.
Yeah.
And it kind of goes back to the Powell thing, right? Like, every time he cleared his throat, you saw the S&P drop a little bit.
But we talked on Friday, and Powell spoke on Friday, and the market was getting creamed. And then Powell spoke.
Yeah.
And then Powell spoke, and the market actually recovered.
He is so comfortable now.
But I think he provides a level of stability that investors are looking for, where it's a little bit of calm in the storm, if you will. Mm-hmm. But that is the one thing that's hard about Trump. Like for all the things that he is good at, like one of the things is like an investor, or especially being an investment advisor, like he's on TV every single day. Like there's something every single day. And so I think that is what is kind of difficult for investors, is like there's something new, newsworthy. Like he likes to basically negotiate in the news which is effective, but is also very difficult if you're watching the stock market every day.
Yeah, because you have to keep up with it.
Yeah. So, I mean, so preparing for maybe a sideways market a little bit. I don't know. The other temptation, and this is definitely what I, struggle with a little bit, is just the temptation of you start seeing stocks that have fallen and you start going, man, that price looks pretty good.
Start buying.
Well, but I mean, the price looks good today, and then tomorrow it's a little bit better, or it could be a little bit better.
Knife.
Yeah. So it's the catching of a falling knife. But like one of the ones, like a company that I thought had a fantastic earnings, which and wouldn't be impacted by tariffs really either, is Netflix.
Yeah.
So Netflix hit a high of 1,064, and it's currently at 888. So 1,064 to 888. So it's already, so there's a lot of names that have already corrected. The NASDAQ's already in correction territory, which is a 10% drop, which is pretty normal every 18 months. The one thing I will say about this is nobody's talking about bubbles anymore.
Because it's all fear driven now.
Yeah, but I mean, it kind of gets that euphoria out of the market.
How quickly do you think it'll be till we go right back to that narrative?
I don't know. I mean, I don't know how long the tariff thing is going to last. I mean, I just don't, you just don't know.
Yeah.
I mean, this is seasonably, like, if you look at last year, the weakest time for the market was like mid-February to, mid-April. I mean, this is seasonably like not normally a very good time for the market.
Yeah. Do you think the market is always anticipating a negative turn versus a positive one?
I mean, it definitely seems like over the last couple of years, we've just climbed a wall of worry.
Yes.
There's always something to worry about, I would say.
I feel like,
but it seems hyper, which might be what you're about to say.
Yeah. It's just funny because I try to talk to people that are in the market a little bit, but they don't do it professionally. They just trade their own book for fun or whatever. And the narrative was very much like, oh, the market, we're going to have a correction. This is not, the market keeps, and this was a year ago.
Right.
Like, and they missed out on all of that run up. Right. Yeah. And then as soon as we come back down, then the narrative for most people is, how much worse do you think it's going to get? And then, so that's really the way they propose that question is it's going to get worse. It's just a question of how much.
Right.
So it's like there's always this negative minded. So, and I feel like that's been more common now, which I don't know how that's going to play out over time.
Well, I mean, it used to be that like you would see stock prices at the end of the day on the nightly news. And today, I mean, there's plenty of channels dedicated. I mean, it can be in your face all the time.
Yeah.
And so you really have to make a conscious, effort to try not to, let it sway you. I mean, like you really do. I think about, there's a chart that shows like what happens if you miss the best days in the market, right? Mm-hmm. So you can find this chart. If you just type in missing the best days, it'll come right up. But there are plenty of them that show, and they're always 20-year periods of time. So the one I'm looking at is $10,000 invested between January of 2023 and December 30th of 2022. So you get in this, you get the financial crisis, you get 2018, you get 2020.
What year did you start?
January 2003.
2003. Okay.
Yeah.
Got it.
To 2022.
Got it. Okay.
So
you get all that volatility.
And you get the volatility of 2022 when they were raising interest rates. So if you had $10,000, you invested in the S&P 500, and you left it just fully invested the entire time, your return was 9.8%, which is what you normally read when you see annualized. So like what has the S&P done? You normally get that 9.8% return. If you miss the 10 best days, so the best day every 2 years, you cut your performance to 5.6%.
Which doesn't seem like a lot, but that's almost half.
Yeah, I mean it is. So it is. You would be at $29,700.
Yeah.
If you miss the 20 best days, which is the best day every year, right? One day a year, you go to 2.9%. And then missing the 30 best days, you're at 0.8. You miss the 40 best, you're negative. After that, you're negative. So, the one thing I'm constantly thinking about, which is what this says, is 7 of the, and this always works out, 7 of the 10 best days occur within 2 weeks of the worst days.
Yep.
So I'm constantly thinking about this on bad days.
What do you usually say? Like, you just got to dip your toe in just a little bit, just a little bit at a time.
Just invest a little bit.
It's so funny though, because you talk about the S&P, and it's like it's the road less traveled because there's less involvement. I think there's less activity. It's not as sexy, whatever. Like, oh yeah, nobody wants to sit at the dinner party saying how they've gotten a 9% because they just dollar cost average S&P.
Right.
But I was thinking about this just recently because from somebody my age. What's something we can do buying the S&P, what is something we can do that we're going to be happy we did down the road? And one of the things that I've found is that we all work for employers, well, not most of us, that have some 401k, and there's a 401k match, right?
Right.
Hopefully you're taking advantage of that. But the default fund that they put you in is a target date fund.
Right.
Of like 2065 or whatever your retirement year that they're predicting you're going to be, right?
2065. That's depressing. Onward.
But what's crazy about that is you look at the contents of those funds and they're charging crazy fees for it because it's actively managed. It's part bond and it's part fixed income, and then it's part basically
stocks,
bunch of different stuff, right? Bunch of equities. But it's like they're charging you so much for that. So I've been working with a lot of friends, not financial advice, talk to your financial advisor.
Right.
But just converting that target date fund just to the S&P.
Yeah.
Usually it's Vanguard or Fidelity. This fee is 1/10 of what you are paying.
0.03, something like that.
Something ridiculously cheap. And it's money that you can't pull out. So this whole sexiness of like, oh, I don't want to do the S&P because it's not sexy or whatever. You don't really have an option for the 401k because you can't pull the money out. You might as well have this S&P machine on your side and your 401k at the very least.
And you're limited to your investment options anyways.
It's like 9 usually.
Yeah,
9 options.
But you can't so you can't really, it's not like you can do individual stocks on most of them anyways. So it is. It's, you basically invest in America and you just leave it alone.
That is something everybody can do right now.
It is. But that's like the whole point of like, talking with you, talking to your generation, is you have like so many young people who are like you said, 401k, you're not going to be able to touch it for 30 years.
Yeah.
And people are making moves like what's going to happen in the next 30 days. Mm-hmm. Or actually, that's not even true. 3 days. Robinhood's doing 0-day options.
Yeah. Well, that's their bread and butter, right?
But it's,
they get a lot of activity that way.
But that's my thought process when I gave that statistic about, baby boomers starting to invest at 35 versus, Gen X or whatever at 19.
Mm-hmm.
It's a much different mindset. And so I worry about like the habits that people, that investors are building, that young investors are building, because are they treating it like a casino?
I think it's very, you even talk about this. It's hard to make behavior change or create it, right? Yeah. I feel like if you're somebody that likes the action, likes, options are pretty tough. So, hopefully you're not. But say you just like the action, the day trading, whatever. Right. Just do yourself a favor, at least if you're working for a company that has a 401k, buy the S&P. So that way, because they can do all that and have fun, and maybe they learn a lot along the way. Right. They learn some hard lessons, right?
Yeah.
But at least they're taking advantage of being invested in the younger years.
Yes.
In the S&P, in their 401k, which they can't touch.
Yeah. Because you can't get the years back, and you got to do something that's consistent.
If you do anything, like if you're like, hey, I do not want to let go of this Robinhood day trading, just do yourself a favor and do that at the least.
Yeah. If you balance it out, like a lot of things, if you balance it out versus it being everything that you have going,
mm-hmm.
Yeah, it makes a huge difference. So we'll see. There's been plenty of times where, like you'll see this Sunday night, the market is down, and then all of a sudden you wake up and it's a completely different story. So you got to be careful on some of these big moves, like the NASDAQ's already improving a little bit. So let's talk about something real. How's your marathon training going?
Oh, it's going good. It was
that scared you a little bit.
It's been a little tough lately, but the
yeah.
hardest part about this is you can't get sick. So if there's a few days that you're not feeling well and you take it off, my gosh, that's half the battle. It's like,
Yeah,
okay,
man.
I got to limit,
Get taking emergencies every other day.
whatever it is. But it's going good. I'm enjoy the process.
Yeah, I'm starting to have like knee, feet, like something's just hurting every time. But I just, but that's, that's the difference in the ages. Yeah. You can, do you stretch? No, I don't stretch. I'm 26. I mean, what do I need to stretch for? I mean,
that reminds me.
I just I do 2 jumping jacks and I go run 20 miles. I mean, that's what I do. So that's the difference. But I am excited to get this. This is when like this next month is so grueling because it's like 15 miles, 17 miles.
Oh, it's a lot.
19 miles,
yeah.
21 miles. Like those are the ones where you're really starting to question things.
But then at that point, I mean, you get on the trail or wherever you're running, the treadmill, whatever, and you don't even think about the mileage because you know it's going to be a lot. So just one foot in front of the other. Man. And then you get to points where it's like, this is the other thing. This is the trick that you taught me. You get to points where you're like, what am I doing? And then you just, okay, I'm going to that tree. After you hit that tree, all right, I'm going to that sign. All right,
just
after that sign,
yourself.
Just lie to yourself. Move the goalpost, as you would say. Yeah.
I always think about that Tom Cruise thing when I start trying to talk myself out of things. I think about that Tom Cruise line where he goes, "We do not negotiate with terrorists."
Oh, what's that?
Is it Tropic Thunder? Yeah. We do not negotiate with terrorists, except it's me. I'm trying to negotiate with myself. It's one of the hardest things is not to negotiate with yourself.
That is probably the difference between people hitting their goals and not. Right there. You probably just summed it up. They negotiated their goal. I think about the Kobe Bryant interview where he said that the contract was signed. It was done.
Yeah.
Like it wasn't a question of if. It was just like, I got to do it.
Yeah. Being able to hold yourself accountable is very key. Oh, that brings up a good point. So I was thinking about, I've had, teaching young people, talking to me about the market not doing well, those kind of things. And how I feel, when I'm looking at my portfolio. So, I was around for the financial crisis, COVID, all these things. At some points when the market isn't doing well, I don't even look at my balance anymore. I look at the share count of the stocks that I have.
Yeah.
And I want to make sure so when I was younger, I was like, man, I want to see if I can get 50 shares of this, 100 shares of this, 1,000 shares. Like I would just make it a share count goal instead of a dollar amount goal, because when the market's going up and down and bobbing all around, I mean, it's a little bit, it gets daunting for everybody. Nobody likes to see themselves lose money on paper. And I think the loss over the last couple weeks is like 3.4 trillion. But who's counting?
Yeah.
But like $3.4 trillion is what's been kind of wiped out. And so you have to come up with a strategy for yourself mentally to just make yourself feel better about kind of where things are. But if you look at stocks that have done well, like AT&T is one I pointed out last week, that has been complete terrible stock over the last 5 years. This year it's done really well. But you look at AT&T, Coca-Cola, Procter & Gamble, all of those steady consumer staple stocks.
Yeah.
I mean, so you got to barbell your portfolio where you have some of the safe stocks and you have some of the, the riskier ones.
It's funny you bring up AT&T. I've been looking into them a little bit more in the last few days. I know you're a big fan of them. I had AT&T for a bit before it got crushed.
Yeah.
So I'm still feeling that. But, running my taxes and expenses this last year, right? I go, what's my phone bill? They have slowly crept that thing up. I mean, $1 here, $1 there, and every month there was not a single month where it was back to back same price.
Wow! So
they're just slowly, and maybe it was $1, maybe it was less than $1, whatever. The only time that it went down was like my second month when it was like a $5 coupon thing that was added.
Yeah,
but I never noticed, and I the only reason why I did is because I'm doing the expenses. But everybody, I mean, they don't notice it either.
Yeah,
and people will literally pay their AT&T phone bill before they pay their light bill.
Yeah.
Because they got to stay connected.
Right.
It's a solid business, and they definitely have a moat.
It's different than it was a couple years ago because they got rid of DirecTV. They got rid of Time Warner.
They slimmed down. They got rid of that debt. They're paying off their debt. They're slowly getting back to kind of the basics, if you will. Yeah.
So if you're thinking about like your portfolio, what do you think like the safest company you own is?
The safest company I own? Well, now I want to say AT&T because we were just talking about it.
You still have it?
Yeah, I do.
Oh, you do? Okay.
Yeah.
I didn't know you still had it.
I still have AT&T, but I'm trying to think of something else.
I have so some of mine would be like I have McDonald's.
Coke. I have McDonald's.
I have McDonald's. I have Coke. I have Waste Management.
Yeah.
I have like some of the ones I talk about on here are things that I own personally. But those are ones where like they just kind of do their thing. I mean, McDonald's has had a good year.
Mm-hmm.
I mean, like some of those, so we'll see. And those are ones that like if you look last year, they are underperformed. But I think so going back to the tariff thing, and we can kind of end on this or wrap it up here in just a little bit. But like looking at tariffs, what companies are not going to be impacted by tariffs? And that's why I was looking at Netflix. I've mentioned that a little bit, but it's like, okay, they're not importing anything. Meta isn't importing anything.
Software companies, they're not.
Software companies. I mean,
they don't have any.
At some point, once the selling kind of levels out, fund managers will go in there and start buying some of these, I think. And then also, too, like tariffs aren't good for the market, when you look at just kind of the impact they bring, but the uncertainty of them is by far worse. Because businesses just don't know how to plan. So when you bring out tariffs and then 2 days you walk them back and then you bring them back and like this 1 step forward, 2 step back thing is very hard for the market to digest.
I've already heard rumors. There's companies that have gone on a 30-day hiring freeze.
Yeah.
With all this information, just so that way, okay, we don't want to, like, what's our biggest expense is hiring people. We're going to stop that for a bit until we figure something out.
Yeah. Yeah. Just to see what's going to happen, just till the tea leaves get a little, clearer.
Do you think, because I know we talked about it and you probably were going to bring this up, but, the price targets for these companies right now aren't,
I forgot about that.
They are not including this tariff, right? Because these price targets were put in before.
Thank you for not letting me forget that. But yeah, so when you look at like price targets for these companies, like you just said, like these price targets for many of these analysts were done before all this tariff news. So you have to be very careful looking at this and going, oh, well, all these analysts, these 30 analysts, tracking this company are showing this price target. Well, that price target doesn't include the impact that tariffs are going to have or what kind of impact that's going to be to their profitability. If we have unemployment go up, that means that those people can't spend money, which means that corporate earnings are going to come down, which means that their stock price is going to come down. So, things are not necessarily good when you look at kind of what's going on right now. I mean, it might get a little bit better once we have clarity, but as of right now, not only, like you said, companies are going to freeze, companies are going on a hiring freeze. Well, there's a lot of people that are just going on a spending freeze.
Oh, yeah.
Like maybe I'm not going to take that vacation. Maybe I'm not going to do this or, I'm just going to, just kind of wait a little bit and see what's out there. I'm going to save a little bit more money this month.
Yeah. Do you think the tariffs, the conversations of them, do you think it creates more opportunity for taking advantage of the mispricing? Or do you think that, we really are not pricing it in well enough and it could be worse?
I don't have an answer to that. I mean, if they were to roll them back, then there's good opportunities. If,
That's
Trump,
the hard part.
Trump said today that like he might raise them. I mean, so then you'd be underpricing them. I mean, like this is like the uncertainty of uncertainty. But if you have a long enough time horizon and you just really come back to like the basics, which is investing in good companies, like you'll be okay. But all that, risky stuff and, all that kind of stuff on the peripheral, I would be really worried about.
And it's also funny too. And I don't know if we want to end on this, but we talk about tariffs. There's these topics that are hot button topics. I think that Trump will bring up. Tariffs is one of them.
Yeah.
But then there's like this subtle stuff that will just kind of fall by the wayside, but it's never been done before. One of them, I'm trying to figure out what this is going to be like, especially for like the tech industry. But what the golden visa? Have you seen that?
Yeah, the $5 million.
$5 million golden visa. So I wonder how many people are going to buy that. What that's going to do for our economy. I don't know. You got to think about like these tech companies, right? Mm-hmm. There is a lot of talent that is not based here in the United States.
Yeah.
And I can imagine some of these companies are going to start putting some money aside because talent is everything, especially in like a company like Netflix. Like, hey, we want to take,
Yeah.
we don't want to just be movies anymore. We want to do live streaming with sports, and we want to do UFC fights. All right. We got to find the guy that can make sure that our website doesn't crash the next Tyson fight we got, right?
Yeah.
Oh yeah, there's a guy, he's overseas. Okay, let's pay the $5 million, get him over here.
Right. Yeah. Or like, well, we were just like the Doge thing, like looking for costs and looking at how many, licenses the government has bought from some of these companies that aren't being used. I mean, so we'll see.
ServiceNow.
Yeah. So we'll see how some of that shakes out. So again, there's just, when you have this like uncertainty, you got to be prepared to sit on your hands. But that's what I'm worried that people won't do. They won't sit on their hands.
No.
They'll be active and they will sabotage themselves.
So that brings up a great point. I did not apply to the broader market 100%. So there was a post. It was like ServiceNow is a great company. This is probably not on ServiceNow's fault, but 39,000 or some odd licenses were sold, and then the U.S. government's only using like 28 of them.
Right.
ServiceNow is very expensive. I promise you that contract, especially with some like uplift renewal fees that are added, are probably pretty expensive. People probably see that. Other owners, CEOs, business owners see that, and they probably are trying to apply the same thing.
Wondering what they're paying for. And from somebody that used to work in the software industry, that mispricing, right, happens more often than you think. Yeah.
100%. They will they'll sell more than they should, right? Because oftentimes,
I mean the licenses.
Yeah. They'll misprice them, or they'll not misprice them. They'll mismatch them in terms of quantity of licenses, right?
Right.
And a lot of it's either based off of, what's the desired growth rate. All right. So we got to factor that in so you don't go over. We don't charge you an overage fee, right? So like that happens so often. So now I'm wondering, how's that going to affect come renewal time? Mm-hmm. All these companies are going to do a software audit, which hasn't been done in probably forever.
Yeah.
And figure out how many of these licenses are we actually using.
It's the same thing. It's like you talking about AT&T and that creep of the bill, right, going up, or the creep of your auto bill going up, like your auto insurance going up, and you're not really like noticing or like getting it looked at every year or whatever. Mm-hmm. I mean, it's the same kind of deal. Like, it's the same thing. So we'll have to, it's one of those things. Like sometimes it's okay to sit on the sidelines a little bit and watch and pick your spots. I mean, this is definitely kind of a pick your spot type of environment. And even that, me reading those statistics of people missing the days in the market, we didn't even talk about the impact that people cost themselves in taxes when they're trading all the time. So again, it's not fun to watch your account go down, but also, I mean, if you have a lot of gains in your account because you've been invested over the last couple of years, you have to be careful because it stinks to watch your account go down 6%. But if you sell, you're going to pay maybe 20% at minimum. Yeah. So, you have to be cognizant of those kind of differences.
And one thing there, I know we're coming up on time, but dividend yield, right?
Yeah.
So like sometimes if you buy your cost base is so low, you only see the 4% or whatever that Johnson & Johnson's paying because you look it up on Yahoo Finance. But if your cost basis is much lower than the stock price, your dividend yield could be much higher. Yeah. And you're basically cashing that out when you sell.
That's true. Yeah,
which is huge.
Exactly right.
That's like a hidden cost people don't really think about.
Well, and especially like if you look at like where we were in 2020 versus 2022, I mean, it would take a lot to get down to some of those prices. And I am not. I'm knocking on some wood here, but like so some of those prices hopefully aren't going to come back. I mean, we might roll back a little bit, but I don't know. We'll see. I think it's just going to be a little bit of that up down action going on. So, all right. So you got anything else? We good?
I think we're good.
All right. So as always, don't mistake activity for achievement. We talked about that a lot today. And we will see you next time. Thanks, everybody. Okay, disclosure time. This podcast contains general information that may not be suitable for everyone. The information contained here should not be construed as personalized investment advice. There is no guarantee that the views and opinions expressed in this podcast will come to pass. Investing in the stock market involves gains and losses and may not be suitable for all investors. Information presented here is subject to change without notice and should not be considered as a solicitation to buy or sell any securities. RightR Equities does not offer legal or tax advice. Please consult the appropriate professional regarding your individual circumstances. Past performance is no guarantee of future results.